Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 13th, 2020. What we'll do in this video is take a look at the agricultural commodities. It's exactly 12:22 Eastern Time now, so we're really rounding out the midpoint of the trading day, and I wanted to update some of the commodities, including those that I've highlighted recently, like coffee, and some of the others that I've highlighted in the past. And again, just take a broad look at that. If you're new to the service, I've always harp on the benefits of asset allocation and diversification. Asset allocation is making sure that you don't have all your eggs in one basket as far as asset classes. Commodities are one asset class, stocks are another asset class, bonds, currencies. You have all different types of things that have very little to low correlation. And even with an asset class like commodities, what we're going to do is focus on agricultural commodities in this video. I'll do an update on energy. I've covered energy stocks or energy commodities quite a bit lately: crude oil, natural gas. And then we'll look at gold, precious metals in another video. But to keep this one kind of concentrated and not run too long, we'll just look at these commodity ETFs and futures and ETNs right now. All right, so we'll start out here with coffee, since I just updated that yesterday. On coffee, in yesterday's update, I mentioned I liked it. I gave it favorable odds that a bottom is already in, with a possibility we could make another jog down. But as I stated in there, I think I give it about a 55% or better chance. About double the chance I gave it that we'll go down and take another jog down. And so far, the charts are firming up. What happened is yesterday I had this level here to watch. I said coffee futures are moving higher, coming up on this 105.62 resistance slash support. Resistance slash price target level. And so today we've taken that out. Nice move, nice follow through in coffee. This is a 60-minute chart here of KC. Those are coffee futures. Just an FYI, if you trade coffee futures, you should know anything you trade. Don't trade a futures contract without going, first of all, knowing how they work, the leverage involved, any other nuances, such as, coffee, for example, doesn't trade the same trading hours that stock futures do. They shut down, I don't offhand, I think it's 2:30 p.m. every day Eastern Time. And then that's it. So where I'm going with that is, if you're in this one, especially if you're in Joe, you need to know that, because if you're wondering why your monitor seems like it's frozen every day, at 3 o'clock, 3:30, you're not seeing anything moving. That's why, because Joe, the ETN, which we'll get to in a second, is just tracking coffee futures. That's all it's doing. And so what happens is this opens up the door now, especially if this breakout can stick. It opens up a door to my next target, and that's quite a ways up there too. That'd be a nice move in coffee if we got there, and we'll just assess it as it goes. If we still can't rule out another jog down, and that's a trend line to watch. Ideally at this point, any pullback should be contained by this trend line. Even better if it can remain above that 105.62 level. So just wanted to state, up 3.55% right now in coffee on the day. And we'll look at Joe. I know a lot of you prefer ETNs and ETFs. That's why I post these. This is a daily chart here of Joe. We've had quite a few trades. In fact, I could be mistaken. I don't believe I am. We were long off the lows on each and every one of these, either officially, unofficially, same thing. I tell you I like a trade, and sometimes it's just a matter of me getting out charts with exact price targets that are adjusted, position size adjustments, suggested stops, all the other notes, and then of course following up on those trades. So this one, as I said, I think, yesterday I mentioned it's, probably a good time. The risk reward is favorable. It's pretty much, again, I don't want to go over what I said yesterday. You guys can read it. It's in this post here, KC and Joe Coffee Futures and ETN analysis. And I've been highlighting this one in the last few weeks as we put in this divergent low. So that's it. I just want to mention that the charts have firmed up a little bit, and Joe, as far as where we're going there, nice move today. Joe is up 3.5% also, and you're coming up on this resistance level here. So although we didn't see that in KC, the coffee future 60-minute chart, I do see resistance here. And what tends to happen, at least this is my theory, and actually I believe it to be true, is that on some ETNs and ETFs like gold, GLD for example, it's the case of the tail wagging the dog. Gold, the ETF tracks gold prices. Joe here tracks coffee or coffee futures, and But what happens is if you get a lot of retail traders, and I really don't know, if Joe has a big enough quantity and enough shares, enough money in this ETN to actually move the futures. It should normally be the other way around. It was when these things are created. They create an ETF. If there's people want to trade futures, but they don't have a futures account. They want to trade commodities, I should say. So that's how they go about it. So in the beginning there, they're just going to track whatever the futures are doing. And then over time, if it gets big enough, it can have an influence. So what I'm getting by that is, if a lot of traders here are in Joe and they see this big old gap right there, it's not just gap resistance. It's you have a lot of reactions along that level that defines it. So let's just say they step in. Those that took along here recently, they step in and they sell it around 34 or so. That could lead to a pullback there. But with that being said, the charts are still constructive, and really, like yesterday, although I take those odds down a little bit that we're going to go make a new low. What was it? I gave it about a 55% chance that we put in a low. That last Wednesday low was the bottom, with a 35% chance of more downside, and then 10% that I'm just plain wrong, meaning this isn't a bear market and it continues to go down a lot more than just a marginal new low. But so I can't rule that out because, like I said, this is where Joe stopped each and every other time before. It's a very well-defined support level, and we reversed just shy. I shared my thoughts on that recently, and as to that's sometimes you get that if all eyes are looking at 31 to buy Joe, the market is cruel. It doesn't always give you that perfect entry you want. So what it'll do is either reverse shy or cut through. You go long at 31, then it clears you out on your stop, and then it turns around. That tends to happen, especially when you get at such a well-defined level. The first two times it was easy, more obvious, and now it would almost be too easy. That's kind of my mindset with this, and that's why I mentioned, go ahead and take in a position. If it makes another jog down, you can always add to that position, or at this point you can raise stops, and if you get stopped out, you can turn around and buy back. So that's it. But what I do like about it, as I said, bullish crossover on the PPO, extreme oversold readings on the RSI, and a reversal close enough to support that it may have satisfied that quote unquote tag or pull back to support. And that's it. There's your targets right there. 3409. Like always, you want to sell a little bit shy of a resistance level if that is your preferred spot to take profits. And if you want to tuck it away, we could be looking at it. It's quite likely sooner or later we're going to see commodities really take off and end their multi-year bear market. We could be looking at the next leg up. So you have to define your trading style and say, do I want to swing trade, get in and out, hit and run, get the quick 5, 6, 10%, whatever it is on a trade, recycle back in, and actively trade, or swing for the fences, or do a little both. That's what I tend to do. I have IRA accounts, and in there I'm not going to actively trade as much. I'll put things away that have a good long-term charts, let them ride, with wider stops in place, not trying to micromanage every time a support or resistance level is hit like I might in my active trading account. By micromanaging, that's what I'm talking about is, either closing along and or actually reversing it to a short, waiting for the pullback, then covering the short, going long again. And that's what I call micromanaging a trade. A lot like with Riot, that I mentioned today. Closing it out yesterday at that second target, waiting for a pullback, which I got today to that 150 level. But I bought back into a fraction of a position that I had before. I'll do an update on Riot and Bitcoin later in a different video. So enough on this. It is one of my favorites. I'll spend a little more time on it. Let's talk another one which I really liked back last year, end of last year, and that's wheat. So here we go on wheat. This was September 9th. If you go back and reference the post, you can type in WAT in the search by ticker drop down box at the bottom of the resources. When you click on resources in the top menu of the site, brings you to the support center, and there's a search function to pull up any quote. So basically back here, wheat appears poised for the next rally following the correction after the last official long trade. So it's like coffee, guys. That's what I do on some of these things. It's wash, rinse, repeat. Go long, 1, 2, 3, hit all our targets there, got out, side averted the whole give back there, and then I recycled him back here, posted as a long, back in. Again, you can most of the charts lately, the timestamp wasn't working. I just noticed after the last few days I added that back in, the date and timestamp on the bottom there. But so that's September 9th. Right here on the breakout at 506, showed you, heading up here. You can see targets first, had us going up here to 552, and went up there, hit the, as you could see in the previous one, I had a resistance level here, that line. That's when the arrow break denotes a reaction, a likely reaction, and that's what you had. So there was your reaction. That line was at 528, pulled back, and there it is. Next buy signal coming to break of 528. That should take us up to 552, and then 575, and so forth and so on. There it was. There was your breakout. Buy signal triggered above a breakout of 528, and so forth and so on. So I want to update that. You know what we'll do? Let's just jump to the charts. Probably enough of the reviewing the old charts. Here's the current chart right here. So again, this is where we're long back here on the breakout. And I want to mention, so we hit our first target, pull back. Second target, overshot it a little bit, but then pulled back. That was an objective buy, which was also, I believe, highlighted in that same post. If we go through those additional charts there, that pullback actually was mentioned right there at that time when we were right there in the notes below. There it is. I said any pullback towards the 528 level would provide an objective new long entry. And so that's what happened, guys. I just want to say this one's played out like a fiddle. I mean, just perfectly all along. There was a pullback to 528 level, next thrust up, and you can see we just stair-stepped higher. But I wanted to do this update. Look, if you weren't around back then, you didn't have wheat, but I think the run is over now. We hit my third target there, had a little reaction, pulled back, went up, and hit the fourth and final target there, slightly overshot it. But as of today, and this is the live chart now, that's the run, and that's why I usually list final targets. That's where the risk reward is either not favorable or I expect the end of a trend. And so there's there's how we captured a trend from bottom or close enough to the bottom all the way up to the top. Why was that the final target? Very solid resistance right here, very solid resistance right there. Well defined. It validated that resistance level, and there it was. We overshot it. Additionally, we broke that trend line right there. You can see we had two little price channels here on the way up. Price channel 1 followed by a mid-level correction, and set up price channel 2, and we broke down below. And so why I don't care to short wheat. I don't think wheat is going to do this again. Anything is possible. It could do that if it wants. However, sooner or later, mark my words, CPI was just reported today. The year-over-year CPI number came in. That's Consumer Price Index, for those who are not familiar. That measures inflation in the economy. The year-over-year came in right at the top of the range. It didn't come in above range expectations, I should say, but it came in at the top of the range. And sooner or later, you're going to see with this hot stock market that the Fed's gunning up, the economy on solid footing and growing, jobs low. You're going to see inflation, wages. You're going to see commodity inflation, or wage inflation, I should say, before commodity inflation, things like that. And commodities are going to be one of the places to be. Now, look, they have been. That's why I'm doing this video again. Asset allocation. This, should have been part of that big piece of a pie that is called your portfolio. A little bit in, commodities, a little bit in equities, a little bit in fixed income, and of course I do what I call tactical asset allocation, which is kind of in and out or overweighting and underweighting the best looking commodities. That's why I spend time doing these videos. I mean, you want to keep it simple. You can buy a commodity fund or ETF, but as I'm going through this video, I'm going to show you all commodities are not created equal. Even within the agricultural commodity arena, they all don't move together, because wheat has nothing to do with coffee. They are grown in completely different environments, different climates. The supply and demand factors are different, and so although they're both agricultural commodities, they have their own different charts. So enough on that. I should talk on wheat futures real quick. Just to confirm, this is a daily chart of ZW, which are wheat futures, and this is also telling me what I'm seeing on the chart of wheat that I just showed you. We broke that trend line right there. There's the uptrend line. This is a daily chart, meaning every candlestick is 1 day of price action. This chart goes back 18 months. But most important is the uptrend there. And then not only that, you had a divergent high, negative divergence at the high right there when you topped. And you can see just like WEAT, the ETN, this was that big level right here. Look at all those reactions. And what this was, it's a fake out, false breakout. We popped above it, but failed to hold the breakout, and that's pretty bearish when that happens. Because why? Because you have a lot of longs that will jump in saying, oh, wheat just broke out of a multi-year base pattern, very bullish. Yeah, it is bullish if it sticks, but I don't. We've said I don't take breakouts that occur while security is overbought and with negative divergence, because those have a higher rate of failing. So, and that's what happened so far. So it has failed, and you can see, beautiful divergent low back there. I mean, these commodities trade just as well to technicals as any stock or anything else out there. So, all right, let's move on. Just like I said, wheat as of now, unless it can somehow power back up, and it's possible. Let me say that too. If the commodity arena, especially the ag commodities, start to catch a broad-based bid, you could see this. And again, I have no desire to short it. Where I normally might short a failed breakdown, no. I'm more interested in being long commodities as a portion of my long-term funds and overall asset allocation mix. Just not wheat right now. Okay, next up is sugar. Sugar has been sweet. Unfortunately, I did not catch this one, but I'm sure at one point I would have pointed back, because I do these videos from time to time, updates on the agricultural commodities. There's hardly ever more than a few months that goes by, unless they're just the charts are all abysmal and not really indicative of either a bull or a bear trend or move. But either way, you can see sugar broke out, and it's just been running. But I think where I'm going with it, I'm updating it not because I'm highlighting this as a trade idea now, because I think the end of the run is probably over, and I'm going to actually look at this one to see if maybe it's worth a tactical trade, a quick pullback short trade. So there's SGG at resistance, about $49. SGG is one of two fairly liquid ETNs or ETFs. Remember, a lot of these are not as liquid because there's not a lot of a lot of people don't trade. When was the last time you were at a cocktail party, and you were talking about sugar instead of Apple or Microsoft? But again, there's a market out there for these, and I like trading things that have a good chart. And I often prefer being at least early on in trade the only one looking at it. I feel better when I'm when the herd is not, everyone else isn't in a trade, especially for a bottoming thing, when no one else wants to talk about or look at sugar. That's when I'm looking at back here at this divergent low on cane, and look at that beautiful downtrend line break right there. And again, that may have likely was highlighted back then at the time, about a 15% run, but pretty significant resistance. I'd have to see enough to short it, and if I did, like I said, it would be a tactical or quick pullback trade, not a strategic long-term hold or anything like that. But you can see support level. If we do pull back, 723 would be an objective place to go long if the charts confirm in the time. Just because it's support doesn't mean you always step in. It's better if you can see, if I see this pullback, let's say at 723-ish, 7.25 level on the daily chart, I'll look at sugar futures, which we'll look at here in a second. I'll look at SGG, which we just looked at, the other ETN that tracks them. And are the 60-minute charts or intraday charts, are they bullish? Are they showing divergence? Or do they look like there might be more downside where we could blow right on through there? So that's what goes into it. It's not always as simple as just stepping in and buying support or selling resistance, but that would be looks like an ideal area, because you have both an uptrend line that comes in and that 725-ish support there. However, before all said and done, I think sugar can run on up here. You can see these were previous price targets when we would have been long here on this bullish falling wedge back there. Breakout, I would have had that was T1. It was hit right there, and I remember I think vaguely remember closing that trade earlier, and this is an example of where I'll sometimes be adaptive. I suspected a sharp pullback, and so I closed the trade there. Recommend take profits, and then it did. It fell back sharply, even below our entry price, and I don't know if I recycled back in or not. I can't recall back then, but you can see the former back then the second target was set right here on that line, and that's exactly where we hit. And then boom, again another sidestep. So the example here, what it shows you how well these things trade to technical analysis. These levels were not added in hindsight; they were added in advance of this move up to here, pull back, that move, big reaction. And you can see all the way back then I had initially a third and final target of 874, which may come into play going forward if the charts continue to firm up. As I said, if I had to be either long or short just about any of these commodities and then throw the key, lock it up, throw the key away for the next year or two, I would be long. These commodities have been in a multi-year bear market, and unlike a stock that might be in a bear market heading down towards low single digits, you don't have Chapter 11 bankruptcy filings in commodities. You don't have a CEO that's some scandal that's going to knock the stock price down. You don't have a competitor that's going to come in and wipe your business out. These are commodities; they're here to stay. So when you're buying them at the end of a multi-year bear market, you're buying them cheap. The only thing is about getting into them and just holding on to them is they don't pay any dividends, so you have potentially a dead money trade. So like I say, I am longer term bullish on these, but we just have to kind of get in and out. And again, that's what I am. That's what this site's all about: swing trading. You get in, make your money, get out, get back in, have the next run, get out. And that's what we do here. So I just want to mention this one's at resistance, so therefore maybe not the best, well, certainly not the best time or most objective time to step in. But if it pops that level with conviction, or it comes and pulls back here, those would be your next buy signals, and there's your next target. Let me give you that number right now. That's an unadjusted level. That's actual resistance at 812, and that line, it's been a while. I may have to tighten that up, sharpen that. Well, it's not no longer an official trade, but that line was at 880 right there. So that's Kane. Let's look at the SGG, the futures, real quick. Yeah, I'm sorry, not SGG, SB. SB are sugar futures right there. That's where the line needs to be, and this is why I may short this one. Boom, boom, boom. There's a pullback to support, and boom. That's the 0.1520 level. Very significant reaction highs. Reaction highs like that often act as resistance, especially when you're extremely overbought. You can see here on the RSI, that's about the most overbought we've been in a long time. You don't even have to look at the RSI to see a run like this from here to here. You can obviously tell that the stock is quite overbought, and that's about a 32% run just off this low, even more if you go back to that reaction low, but really hasn't even taken much of a breather since that 32% run had a little jog there and a little jog there. So again, risk reward is not attractive for a long right now, and I'd have to look at the 60-minute chart. Okay, I had to pause the video there. I liked what I saw. I am the proud owner of starter position in this. I'll wait and add. Went ahead and shorted. Now look, here's the thing. It hasn't triggered a sell signal yet, but the basis was that run up to resistance, and we have a negative divergence here on the 60-minute chart. And what I'll plan to do is add if and when we take out this uptrend line, targeting, sharpen my pencil on that. Usually I have the targets outlined in advance, but I could see right here, at least down here to that 1443 level. And that should be good for right at about a 4%. Yep, right on a 4% pullback from right where we're at right now. So again, that's now it could be more. Remember, that's a major level there, that long-term resistance. So here's an additional trend line there that comes into play if that's taken out. So a lot of trades, kind of on the go. It depends what happens. And what does that mean? Let's look at the daily chart. Go back to SGG. I'm probably spending more time on sugar than I want, than you guys might want, but I see a trading up there, so I'm going to spend a little time on it. Let's say we get a big bearish reversing candle, or some type of maybe an island cluster top. You see two candles there, that forms an island. If we gap down tomorrow, that would form an island cluster top. Those are pretty high probability reversal patterns, and if nothing else, I love to short them because they're objective. You gap down here, you put a candle right there tomorrow, you can take a short position, and with a stop somewhat above, you can have a tight stop at the bottom, but I like to go around the midpoint to no higher than above the top of the island cluster there. And so your risk reward, because it's a topping pattern, not just a little pullback pattern, you could have minimal downside, couple percentage points, and maybe double digit gains to the downside if sugar puts in a reversal. Major top, pulls back. So you can see on SGG 45.23 is a potential target, as is this level here, and then Kane. I had some levels for you there as well, I think. Yeah, I already went over Kane, showed you where the pullback levels are. Trend line 723. Potential targets. There's some minor supports in that area-ish right there, right somewhere around there. That's 746. That'd be a minimum, but again, based on that, I think we go through that one. Hit this somewhere most likely. Okay, and for those of you still with me, next up is soybeans, SOYB. This is the soybean ETN, tracks soybean prices. And you had a nice downtrend line there. It was taken out. You can see this thing is it trades. It looks like an EKG. You go up, down, and up, down. And you can see now this is the level right here. Here's our upper end of the range. That would be a swing target up there if you catch it down here. Because the way I see this, what I spy with my little eyes is just a simple trading range, and like I just showed you there, wash, rinse, repeat. Go long at the bottom, sell at the top. Long at the bottom, sell at the top. There's some resistance levels in between. You went long there, it went up to here. You can see those lines. But even then, if you went long there, you came back to entry. You never went upside down on the trade. And so what we see here, I like this quite a bit. You might say, Randy, look, you broke support there. Actually, to me, that's bullish. Why is that bullish when a break of support should be bearish? Because that's a fake out move. That's a false breakdown, aka whipsaw signal, bear trap, or bear trap. Call it what you want. What happens is bears that are bearish on soybeans see the breakdown of the well-defined support, so they short. Well, when the security regains that level, they realize they're wrong. That's bullshit that recovered, and if it continues to go up, they get squeezed out. And when a short seller gets squeezed out, they have to buy the position to close it out. That's what you're doing. You sell short. You're selling shares you don't own to begin with. Somebody else's shares. That's what you're actually doing from a broker if you're shorting SOYB. And then at some point you must close that trade out. So the more it goes against them, they're feeling the pain. And it's exactly the same as you buying a stock long and it goes down against you, and then you start to get stopped out. Your stop on a long trade is a sell order, and then selling begets more selling. It pushes prices down further. So anywho, and the thing is, look, maybe I'm wrong on my analysis. Maybe that's not what happens, but I can tell you it's subjective, because you go long here with a stop somewhat below. You could go below that recent low, or you could use it a little tighter there around that 1466 level. And this looks like a potential swing for a move back up to the top of the channel, maybe even above. Again, sooner or later these commodities may or will, I should say, let me be very clear, they will embark on the next bull market. Right now, can you go back in time, it's a multi-year basing pattern in a bear market. This is soybeans going back, or that ETN going back all the way to 2011, peaked right here, and like most commodities, it has been in a bear market since. So like I said, go back to here and you might say, that's not bad, looks compelling. It's not huge gains. It's not like these .com or internet stocks or biotechs that we trade that get 30, 40, 50% plus gains. Well, that's about an 8% gain to the top of the channel from here. But again, if it breaks above that channel, that is going to, or the price trading range, it's going to be bullish. It could take us up here to that next target, about 1685. That's about a 13% gain. And then at that point, we might have some pretty solid evidence of a bottom in soybeans, and we turn our focus back to this weekly chart and say, wow, well, what if we go back to where soybeans were trading just a few, 7-8 years ago? We're talking 80+%, almost 90% to get back to the highs in 2012. And if inflation starts to rear its ugly head, that's what you're going to see. You're going to see commodity prices going up. All right, we'll wrap it up here. There are other ag commodities out there. These are the ones that I went through and looking at the charts that I wanted to share with you because I think they're actionable trade ideas, mostly longs. There was that one short in there. And then, of course, I've highlighted this in the past for you guys. If you want a pure play, you say, Randy, I don't have the time. It's too much to try to manage all those different ones. I want a one-size-fits-all. DBA is an ETF that holds agricultural commodities. I haven't updated this in a while, but you can see back here, live cattle, soybeans, sugar, corn, cocoa, wheat, coffee, lean hogs, feeder cattle, and cotton. And again, you can visit their website, and they'll tell you what the current allocations are. And it has been moving up, and again, at some point, the bear market in commodities will be over. Maybe this was it, and I put pretty decent odds that was it, and I believe that would have been highlighted back then. We had a divergent low back in September. That was about the time, what was that first one I started with? Wheat, where I showed you that's where, I was looking at going long wheat and coffee. We were long and all that, and we caught that thrust up, and now, so what I'm looking at is that's quite likely will prove to be, the initial thrust up on this ETF. That may have been the first corrective wave, and we may be looking at another leg up. And you can see some target levels laid out here. That 1691 is a pretty well-defined level. Lots of reactions on it from both above and below. That's what you want to look for, ideally. And so that would be a natural, next target. And then, more importantly, if and when it breaks that 17-ish level, then you start to look at some of the additional upside targets. You roll out to the longer-term charts. You look at some long-term trend lines coming in, things like that. The other one that I like too, and I've highlighted for you guys, remember this is agricultural commodities only, but if you go with GCC, if you wanted a true one-size-fits-all commodity ETF, then this is the one for you, or one of the ones for you. GCC, it holds index components, according to their site, it says equally weighted cocoa, coffee, copper, coin, soybeans, cotton, crude oil, gold, heating oil, lean hogs, live cattle, natural gas, platinum, silver, soy, oil, sugar, and wheat. So there it is, guys. You want commodities. You don't want to have to work hard at managing these individual positions. Here's one that you can look at. And it's the Wisdom Tree Continuous Commodity Index Fund. Just presented a nice buying op right here at this 1740 level. You can see that level has acted as support on numerous occasions. We had this one little breakdown below it, but we recovered it and have been holding it since. There is some, there are going to be minor resistance levels along the way, such as right about here. I can certainly see that being resistance that we're at now, but if it can take that out, then it should power on higher. I'm giving you some additional levels which you can target. But here's kind of the big range in the last few years here. So if you're a trend or position trader, or a long-term swing trader, you go long here and hold out for the top of that range about 1883. And again, longer-term bullish if and when that breaks out. But just to get there from here, you're talking another 6%. Again, not stellar returns, but this is not as aggressive and risky as those biotechs that we trade that can put in 50% plus returns in short order. So you don't have to take your position size down as much. You can have a decent sized position, and if nothing else, there are going to be times where your commodities are doing great and your stock portion of your account or your bonds or your gold or something else is going down. So it's a way to, like I said, have that asset allocation. Spread your bets, and again, go in there. I like to go in there, strategically or tactically, not just randomly, like for like a lot of financial advisors. I used to be a financial advisor, but that's they're going to tell you do an asset allocation model, and that is sound advice too. Don't get me wrong on doing the asset allocation mix and being diversified. I just take it a little step further because I'm an active trader and I use technical analysis. So I will again strategically or tactically change my asset allocation mix and weightings in each sector. All right, we're going to wrap it up here, and I'll get this out to you guys, and I will follow up with some separate updates on the energy sector, commodities such as natural gas and crude oil, as well as precious metals. There's some things that I do want to highlight and point out to you guys on those, so that'll be in a separate video, or static charts. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.